Hello again, and welcome to the January 2025 first quarter Hightower Naples market commentary. I'm Mark Masterson, partner here at Hightower Naples, and I want to wish you and yours a slightly belated Happy New Year. 2025 promises to be an interesting year, and as I talk to clients, I'm sensing both optimism and a little bit of trepidation. And perhaps that's because, like me, they sense a unique blend this year of both headwinds and tailwinds for the market and the country. And that's part of the reason why I'm calling this commentary Headwinds and Tailwinds. And we're going to take a look at both sides as we start the year. So let's jump right in. As always, beginning with the four horsemen. And I'm keeping this one pretty neutral because headwinds and tailwinds seem pretty evenly divided at the moment. So if we look at fundamentals first, keeping it neutral because we know that Trump's policy should rekindle some economic growth, lower taxes, lower regulation, etc. Optimism's definitely on the rise. But we also know that growth's been driven the last few years by deficit spending and debt. And we know that Trump and the DOGE committee have made a commitment to cut that. So it's going to be interesting to see how that plays out. We know the debt ceiling's back, and we know that timing and the impact of policy changes are unknown as we start the year. So we'll keep it this way for now. Technical analysis is also neutral. We've seen some of the overbought conditions get corrected, which is good. But really a lot of the assets that I follow in different asset classes are a bit in no man's land at the moment. We've got sentiment at bearish because sentiment's a contrary indicator. And when everybody's super bullish, that is a bearish event, and when everybody's very bearish, that's bullish from a sentiment standpoint. So we know that until this gets corrected a bit on sentiment side, we got to keep it more cautious. And then finally, policy's neutral too. We know the Fed's been cutting rates. That's normally a very positive thing, but we also know that the Fed has made some comments that if inflation continues to rise, that cutting cycle may slow. So we're going to keep an eye on that. And fiscal policies in question. As I mentioned over here, we've been spending like drunken sailors for the last 2 years, and that may be about to change. So we got to keep this neutral as well. So we're fairly neutral until we see how the headwinds and the tailwinds unfold. So for now, we're going to focus on tailwinds. Let's take a look. First, Wall Street, very optimistic, as it tends to be. Looking forward, Wall Street's outlook for next year range 7 to 19% on the upside. So most Wall Street firms are looking at the positive side of things. It is notable that they do tend to be a little overly optimistic, but that's okay. That's where we stand as we start the year. So we've got a nice healthy optimism. We know that history's on the side of the market moving higher. Typically post-election, the market moves up into the inauguration. Then we have a bit of a pause and the market moves sideways, and then we continue the upside. So historically, very positive trend which is a tailwind. I mentioned optimism's on the rise, and this can be a very powerful force. So if you look at some of these recent surveys, U.S. economic optimism rose to the highest level in more than 3 years after Trump won the election. Very positive sign. I like this one a lot, actually. The small business optimism's on the rise. We had one of the largest rises ever, biggest monthly change in 30 years in small business optimism. And again, that's just businesses looking forward to Trump's policies and feeling good that they're going to be good for business. And just so you know, small businesses matter. 99% of companies in America are small businesses. And so that's a very positive and can be a self-fulfilling dynamic if we have a lot of optimism there. How about CFOs? Well, CFOs also are showing a rise in optimism post-Trump's victory. And that tends to be a good thing because CFOs oftentimes pull the trigger on spending. And that kind of is reflected in this chart here that I just saw this morning, that 43% say they're expecting to increase CapEx an additional 14%. So again, CapEx is just spending within companies. And I think if they are comfortable with tax policy, then they will be willing to spend more money. And that's a good thing for the economy. So that's a tailwind. We also have loose financial conditions, which is interesting because the Fed's been raising rates, up until a couple of months ago. But you can see the financial conditions index is about as loose as it's been, even since when the Fed started hiking rates a couple of years ago. Loose financial conditions tend to be a tailwind. As this chart, which is about a month and a half old, but 2 months old, but you can see financial conditions. Global money supply has been on the rise. A lot of that's driven by China, but again, looser conditions tend to be a tailwind for markets and the economy. And we also see central banks around the world cutting. This is through November, but there were 62 cuts going on at that point through November. So a lot of rate cutting going on, including the Fed, of course, and rate cuts normally tend to be a source of liquidity. So optimism, liquidity, policy shifts on some fronts tend to be a tailwind as we head into 2025. So let's take a look at some of the opposite, the headwinds that I mentioned. We'll start with the main policy shift that's going to be interesting and see it evolve in the first half of the year. So we know, I think it's pretty much agreed that the last couple of years have been driven, economic growth has been driven by deficit spending. I mean, it plays out in all the facts and data. We know last year for 2024, we had a massive deficit, almost $2 trillion, and 23% of all government revenue went to interest on the debt expansion. So that's an interesting dynamic that I think Trump and his team are trying to alter. We saw that as we ended the fiscal year and started the fiscal year for 2025, we had massive spending right ahead of the election. We had a $640 billion deficit in October and November, which happens to be a record for those 2 months. So it was a really extreme spending spree ahead of the election to try to keep the economy moving forward, of course. But I will say that becomes a headwind as we move into 2025, because the likelihood of that being able to continue is not very good. And then you can see here one of the challenges that the Trump team faces is we have a lot of debt maturing this year. In 2025, I've read there's about $9 trillion of debt, and a lot of it is coming due early in the year. So this could become a headwind because if you look at the average interest that's paid on this debt that now is maturing, it's about 2.7%, and now we know interest rates are higher than that. So if we have to refinance at today's 4 to 5% rate, that's going to raise the amount of interest that has to be paid on those debts. And that's going to just soak up more of our revenue. So this, to me, is a headwind that has to be dealt with, in a challenge that the Trump administration and his new Treasury Secretary Bessent is going to have to address. I would call that a headwind. And Trump knows it, actually, because we have here's a chart that shows the debt expanding, and you can see this flat line here. This is when the debt ceiling came into effect. Here's where they eliminated it up until now, January of 2025. So once they eliminated it, we had a massive expansion of debt, which fueled the economy. But now we have a debt ceiling again that has to be renegotiated in the first half of the year. I call that a headwind. And Trump actually commented on that about a week or two ago, saying he desperately wants the debt ceiling to be raised. And the reason for it is because he wants to buy time, because it's hard to change policy. You can't just do it overnight, and you can't have a situation whereby the debt ceiling comes into play, the government can't borrow and spend while we're trying to manage into a new policy regime. So I call that a headwind as well. This is interesting. This is inflation. So inflation could be a headwind or a tailwind. We just have to see how it evolves. It's been a tailwind, as you can see. When it's rising, it's a headwind. It's been falling, which has been a tailwind, but it's stalled. And this is what the Fed has noted. The last few months, it's stopped going down. So will it rise and have a similar dynamic to the 1970s, or will it just keep coming down? We'll have to see. I would suggest to you it could be a headwind or a tailwind, but if it rises, that's a headwind because that's going to keep the Fed on hold. They won't be able to cut rates, and we know inflation is hard on Americans. So that could be a headwind or a tailwind as we enter 2025, but it's kind of an unknown. The Fed cutting rates may be a headwind because if you take a look at this chart I've shown over the years, over the last 2 years, the 2-year Treasury yield is this blue line, and the Fed funds rate tends to follow the 2-year Treasury. So as the 2-year Treasury went down, that gave the Fed room to cut rates. But since Trump won, 2-year Treasury yield has been rising, and now they're back to even. And that to me suggests that the Fed may have a much more difficult time cutting rates in 2025. So we'll have to see how that unfolds. But rates could be a key component of whether it's a headwind or a tailwind moving into next year. You can see the 10-year Treasury yield, kind of a similar dynamic where post-Trump's victory here, yield started to rise right here, right after the victory. And we kind of broke out a little bit. So, are yields going to keep rising or are they going to come down? Well, that's to be determined whether it will be a headwind or a tailwind. If the 10-year Treasury yield can come down, that's a tailwind for a lot of assets typically. Real estate, mortgages, you name it. But if it stays elevated, even staying where it is or rises, that's a headwind. So I think Trump will have his eye on this and try to find ways to bring those down. But again, Trump and the administration, no administration really completely controls this. So, this is more of a market-driven dynamic normally, unless the Fed gets involved and starts doing QE again, which they're not doing right now. So we'll keep an eye on this. Could be a headwind. If it keeps rising, interest rates are a key component. And one of the final charts, this is one of the most important charts in the world. I've always said that is the US dollar. And you can see, after Trump won, it just rocketed higher. A strong dollar based on some of his policies. But a strong dollar is a headwind in some respects, for U.S. corporations, for commodities, things of that nature. And we saw it actually break out of this channel. So is it going to continue to rise? I mean, it is very overbought, as you can see. So it's due to pull back. But the question is, how far is it going to pull back? Is the dollar going to be a headwind or a tailwind? A falling dollar tends to be a tailwind. A rising dollar tends to be a headwind. I'll show you a little longer term chart. You can see it's in a rising channel. And here we are. And to be determined, is it going to rise to the top of the channel or is it going to just kind of falter here and make its way down to the lower? I've made the case and believed that it would probably move lower because I think Trump's going to want a weaker dollar actually as we move into his term. But to be determined, and it's it's not necessarily controlled by just Trump's policies or the Fed. Some of it's just the weight of other currencies. So you remember the dollar is just a basket of when you look at whether the dollar is strong or weak, it's against a basket of currencies, and almost 60% of that basket is the euro. And you can see in this chart how they move opposite. So the blue line is the dollar, this is the euro. And when the euro is rising, the dollar's falling, and they just move in tandem. And part of the strength of this dollar has been the massive weakness of the euro. So how low can it go? Is it going to reverse and bounce? Because if it does, the dollar is going to fall, and we shall see. I will note that in a recent article, Bank of America said that the dollar is now the most overvalued in history, according to some of their metrics. So that would make a case that the dollar could get weaker. And I would also suggest, and I've shown this chart, listen, the dollar's world's reserve currency status can't go on forever. At least historically, you can look back since the 1500s, each world reserve currency lasted at most about 100 years. And you can see by the length of this blue bar, it's about the same as even the longest term that we've seen. So there are no alternatives at the moment, but at some point there will be, and we'll have a new reserve currency. And I'm sure if that happens, the dollar will go lower, but that's to be determined as well. So we're going to keep an eye on headwinds and tailwinds, and I've highlighted a few of those. I'm going to point out a few others as I move through. So one of the headwinds that I see that perhaps bothers me the most is just the pure valuation standpoint for the market. And this is not a market timing tool, but it's not something that can be ignored. So I think, and this is not something that Trump can control or any administration can control. But if you look at where we are, the facts suggest that the market's valuations are elevated relative to history, and that may be putting it mildly. So I'm just going to go through a few charts that show that. Bank of America highlighted how right now on the trailing price to earnings ratio for the S&P, it's the fourth highest reading in 124 years. So we've been higher, but it's pretty rare to be higher, and that's on the trailing PE. And on a forward PE basis, we've reached the second most expensive valuation since the dot-com bubble of '99. So, price to earnings definitely elevated. And when you get elevated, like you can see here, usually what it tells you is that when you start from an elevated level, it's harder for the market to have good 10-year returns. You can see right here, here's where we are, and here's the 10-year returns of every other incidence where we've been this high. They're either flat to negative over 10 years. Does that mean anything over the next 10 days, 10 weeks, or 10 months? No, not necessarily. But what it tells you is that your starting point matters from a long-term investor perspective, and we're elevated. Price to book, you can see, again, it's rarely been higher for the S&P 500. Price to book is elevated. Here's the price to book again. Here's the price sale to sales ratio, very elevated. Here's the Buffett indicator, which is basically the market cap of the stock market compared to GDP. So you compare the market to the economy. You can see never been higher, very high, over 200%. Another way to look at it here, same thing. But you can see where other peaks were on this. We're quite high, and perhaps that's why Buffett is holding 30% in cash. That's why they call it the Buffett indicator, because I think he looks at it as maybe a very poor market timing tool to just suggest that the market is a little extended relative to the economy, and he's got a lot of cash, like he did here, like he did here, like he did here, but he's got a lot of cash. Simple fact. Another thing that I view as a dynamic that is unusual, that could be a headwind, is just the pure concentration of the market. You can see that the top 10 stocks now account for 40% of the index. That's great as the market's going up, as I'm going to show you, but just keep in mind that's a very concentrated market historically. And in fact, the three largest companies in the S&P are 20% of the index. So it's extremely concentrated. And what happens when that takes place is the average stock is drastically underperforming the index. You can see the equal weight S&P is way down here in terms of relative performance to the broad index. So if you equal weighted all the stocks, keeping them in there, but equal weighting them versus those 40%, those 10 stocks representing 40%, you can see it's down at levels we saw back in 2021 and then back here in 2008. So very dynamic concentration. You can see it again here. This is the percent of stocks that are outperforming the index. It's really low. It's very low. So the concentration makes, really, I call it kind of an indexer's dream, because if you don't own those 10 stocks, you can see the performance of those 10 stocks is in red versus the broad index. It was over half of the performance of the index for the year was just holding those 10 stocks. And I meant to show you one more chart. Well, I'll come back to that chart, but this shows you that since the bottom in 2022, the top 10 stocks have represented 60% of the return of the index, and the next 10 stocks are 11. So if you take those two together, those 20 stocks were 70% of the return of the index. So it's been an indexer's dream the last 2 years for sure. A very concentrated market indeed. And lastly, let's take a look at sentiment. I highlighted it in the Four Horsemen, how sentiment is one of the few bearish. Everything else was pretty neutral, but the reason why is because when you get to extreme sentiment, it's a contrarian indicator. And here's what I'm pointing out and suggesting, and this isn't necessarily short term, but it's rare to see so many people expecting the market to go up. So this is one of the highest, if not the highest, ratio of Americans expecting the stock market to rise that we've ever seen. You can see it in a different reading. This is from a different index, same result. 56% think that prices will go higher in the market. That's a very optimistic view. And thus, they've got the most in equity that we've seen since back here in 2000. I mean, most of the time, we don't have this much allocated to stocks, but it's been such a strong index return, again, driven by a very narrow leadership, that we got a lot of people exposed to the market, which is fine. Insiders, and that's not a shock, by the way. When the market's going up, people want more, for sure. Insider selling has spiked to a level we haven't seen in a while, so we are seeing some profit taking from the inside, but the fund flows have been very strong into the market. You can see it here. Equity allocation surged to the highs that we've seen in a long time, since '08, and cash has been dumped. So we have less cash, and we have a lot of foreign buyers. You can see the level of foreign investors that are buying U.S. stocks has reached a level we haven't seen in, going back to 2002 maybe. So very, very extreme sentiment on that front. So those are some of the headwinds. Concentration and valuation are things that cannot be controlled by the administration. Some of the other headwinds, potential headwinds like inflation and interest rates to a degree, some of those things can, and the debt ceiling and some of the government spending, those things are all policy driven and can be adjusted to, but they could be headwinds for a short period of time. Here's a few. I'm just going to wrap up this commentary with a few other notable charts. I'm going to start with gold. Gold has, I've highlighted this. It's been a holding of ours at the high end of our allocation for a while here. Last 2 years have been very strong, but I note that this has been a very large base. Gold broke out of a 13-year base last year, and a 13-year base is a long base that tends to build a lot of energy. So the longer the base, the higher in space is the old saying, and I think that it does give a strong potential for gold to continue to be a good performer for client portfolios. 71% of all investment advisors hold less than 1% in gold. So if we just see gold continue to perform, and advisors, we have a lot more than that, by the way, but if advisors start adding to gold as part of their allocation, it should be a positive development. And you can see this is a ratio of gold to stocks, and when this is rising, gold's outperforming stocks. When it's falling, stocks are outperforming gold, and you can see it's been underperforming stocks for a while. So we may enter a period where gold starts to, kind of like we saw in these periods where gold starts to outperform equities. That would be an interesting and unusual development. How about commodities? Well, commodities are building a base too. You can see they've been moving sideways. The bigger the base, the higher in space. This is a multi-year consolidation. It's not going down. It's not going up. It's just building energy to pick a direction. I suspect it'll be higher, but we'll see. Something to keep an eye on. Here's a longer-term view of commodities. Commodities suffered a huge bear market for a long time. This goes all the way back to '08. This was a very long 12, 13-year bear market. It finally bottomed after COVID, had a huge rally, and now it's been building this base, moving sideways. I suspect it's going to want to break higher. You can see the same thing. I showed you the chart of gold versus stocks. This is commodities versus stocks. And when this is rising, commodities are outperforming stocks. When it's falling, stocks are outperforming commodities. We've been in a period of stocks outperforming commodities, and I suspect eventually this is going to turn higher and commodities will outperform stocks for a while. That doesn't mean stocks don't move up. It just means that commodities outperform them. And that would make sense, because if you look at this chart that shows returns of all assets going all the way back to 2011 through the end of last year, a whole lot of green over here, but you will note that one asset class was negative for that entire period, and that is commodities. And so, typically we tend to see mean reversion where the worst performers become the best performers, or at least outperformers. And I think that's something that we can expect to see. And I'll take a quick, factual look at Bitcoin, certainly getting a lot of attention post-Trump's election. Here's the annual returns of Bitcoin through the end of last year. Pretty darn spectacular on an annual basis, as you know, except for these every 3 to 4 years, these massive drawdowns on an annual basis that just wipe out half to 3/4 of your gains. So keep that in mind. It's a very volatile asset for those that invest. That last chart showed you the annual returns. Here's the intra-year declines, and this is one I've shown to clients. Just be aware that with all the upside that comes with it, you got to endure these kinds of intra-year drawdowns. They happen all the time. You can see the dates. They happen pretty regularly, anywhere from 30% to 70, 90. Pretty strong volatility there on both directions. A lot of people are saying, hey, it's because of the election of Trump being elected and being very pro crypto that Bitcoin's been rising. But this was an interesting chart that shows that really, if you go back to it for whatever reason, every time we had an election, Bitcoin tended to rally. This goes all the way back to Obama's election. You know, we had a rally. This was Trump's first victory. This was Biden. And now we have another rally. So interesting to see that dynamic. Some of it's being driven by Wall Street. Here we have ETFs, and you can see they've now gobbled up 5% of the supply of Bitcoin. This other chart is kind of the other side of the coin. You know, one of the arguments that's made around Bitcoin is it's capped at a certain number, but did you know that there's over 15,000 different cryptocurrencies? So there's kind of an unlimited number of cryptocurrencies. None of them are as institutionally accepted, I'd say, as Bitcoin. But just so you know, it's just a proliferation of these things, and there's just no way they all make it. I mean, the odds are that, you know, very, very few are going to survive. So keep that in mind. So let me summarize as I wrap this up. Headwinds, tailwinds is our theme as we start the year. I'd say fairly equally weighted. We'll have to see how things evolve. Let's take a look at the tailwinds. We know Trump's going to be very pro-growth policy, tax cuts, deregulation, more M&A is very likely, higher CapEx, all positive things. We know sentiment is rising. We've got animal spirits have kind of been reignited. We've got economic optimism on the rise. I talked about that with small business surveys. That's great. A little more patriotism in the U.S., kind of a U.S.-centric policy. We've got a little bit of a youth movement coming in with his administration. And we've got some different thinking towards some of the secular problems we face, like debts and deficits and spending and healthcare and regulation. And again, for the most part, from an economic standpoint, a market standpoint, those are positive developments. Those are tailwinds. On the other side of the coin, we've got some headwinds. I call it fake growth, but it's not. It's just growth driven by government spending and deficits and some of the inflationary impact of that. So we know that that's been going on. The challenge is it going to slow? And if it's not sustainable, and if the debt ceiling returns in January, running those deficits becomes more of a challenge, and that could be a short-term impediment to economic growth. We also know job gains were dominated by the government last year, and if the Doge committee comes in and reverses that trend by cutting a lot of jobs, that could hit the jobs numbers. We have spending reduced. We have potential inflation, whether that's going to be a headwind or a tailwind. We will find out. We've got the Fed. If inflation doesn't come down, if it stays where it is or starts to rise, the Fed won't be able to cut rates. So that's a policy issue. And we know markets, valuations and sentiment are a bit hot. So the key questions coming in: will the real growth driven by private sector policy reforms offset the decline in government spending and government jobs? And what will be the timing of that? That's a question that we'll have to see in the first and second quarter of the year. Will inflation derail the rally or not? Good question. We'll find out. Interest rates are also a headwind or a tailwind, depending on their direction. And then I kind of compare it, lastly, a kind of a parting thought is, if you look at the Reagan administration, when Reagan took office, he was considered somewhat of a transformational president, but it wasn't easy. You know, in his first year, people forget that in his first year, he had to fix some of the issues that he inherited, like when Carter left office, you know, we had very high inflation rates. And so Volcker had to come in and raise rates to 20% in the Fed funds rate to kill inflation, which also killed the economy. So in dealing with some of those problems to get things in a good direction, his first year was kind of riddled with a slowing economy, a recession, and a stock market that had a bear market. And then it kicked off one of the largest bull markets in history. And I would say to you, are we going to see a similar thing this time around where Trump comes in and has some challenges in dealing with policy that has been in place, and then we kick off a more sustainable rally or not? So these are some of the questions as we look at headwinds and tailwinds, and together we'll navigate them as we move into 2025. So I'm going to go ahead and end our commentary with that and say thank you again for your friendship and your business, and we appreciate it very much. You know where to reach us. You can call the office, talk to Dave or myself, always available, and we look forward to going through all of these points and others as we move into our first quarter reviews together. Thank you very much.